Very good morning, ladies and gentlemen. It's 11:03 a.m., so let's begin. My name is Daryl. Thank you for joining us this Thursday morning and welcome to CapBridge educational webinar. For those of you who are unaware, this is the final part of a two-part webinar series in partnership with Minterest, where we will explore and share our thoughts on how you can future-proof your portfolio. Today's session will focus on institutional-grade real estate equity. Our list of panelists today includes Johnson, our founder and CEO of CapBridge Financial. We have Sharon, Chief Commercial Officer of Minterest, and also Alvin, Head of Investor Relations and Partnerships at Minterest as well. Just a quick note before we begin. All attendees will be muted throughout the webinar. We will be having a Q&A at the end of the webinar, so feel free to type your questions in the Q&A box in Zoom, and our panelists will answer them at the end. Okay. So without further ado, let's kick things off. I'll hand over the time now to Johnson, founder and CEO of CapBridge Financial, where he will be giving a quick intro to real estate and private markets. Johnson, please.
Thanks very much. Just start sharing. Right. So thanks everyone for your time. Know everyone is busy and much appreciate for joining us this morning. So today's topic is really on the future-proofing your portfolio, and we're focusing on this institutional grade real estate from the equity perspective. I also thought today to kind of share what CapBridge is working on, and how CapBridge could potentially help build your own investment portfolio. So what we have here is that we call the solution of ours called the FIT solution. So a quick recap of CapBridge. CapBridge has two parts of the business. We have a dealing in security license whereby we are able to distribute and structure investments, and a private exchange license under one exchange. So we work hand in hand, and our main strategy is that what we call the FIT, which is basically fractionalized, interconnected, and tradable. So you may have heard the term fractionalization. What this means is basically we're splitting this into smaller ticket sizes. So traditionally, the global institutions have high minimums. Typically, 1 million check sizes. What we're doing here is that we're breaking this down into smaller pieces. The second one, which is interconnected, is basically how we as an exchange can also cross-link and further link up to other exchanges and cross-platform. So we see this as a huge opportunity in that we are able to actually curate and offer and procure new products and offering. So we are working with various exchanges and liquidity pool to bring a set of nice products to allow the individual investors to build the portfolio. So lastly, we have T, which is tradable. And with our private exchange license, one of the nice things that we can do is that we can basically tokenize this, give it a ticker symbol, and make it a regulated product, which again, making it fungible will allow us to cross-list and make it tradable on other exchanges and platforms. And that's really what our objective is. So with our FIT strategy in mind, what we're building here is really the private market space. And the private market is very broad, and typically, there's quite a few products. At CapBridge, we're focusing on the key 4 product, and we do look at other things like ESG and some of the crypto indexes. So our objective here is really to create and offer the top tier private market products. And these products are traditionally restricted to private banking, wealth clients, family offices, and institutional firms. So what we're doing is that we're hoping to open up the access through our FIT strategy and broadening this and providing the access to the mass affluent and sophisticated investor using the various digital technologies and leveraging on blockchain. So here we have, some of our product pipelines. So, in terms of that, we have the unicorns, the pre-IPO as a first asset class, which we have done. On the second one, we have the real estate asset-backed instrument, which is the key top topic for today's webinar. We're also working to provide access to the top tier PE and VC funds as part of a wider asset allocation to the individual investors. And fourthly, we're also quite excited about our, fractionalized wholesale corporate bonds, or we call it the institutional grade LISCO bonds. So these are typically, previously only available to the ultra high net worth individuals, and typically the minimum ticket size, is 200K and above, and typically people will invest, 5 to 10 million per ticket. So now what we're doing, and we'll be launching this shortly, is that we are fractionalizing down to 1,000, so that people can buy into this. And we believe that this could be a very nice stable yield product because this is a kind of a bonds portfolio, and this will be forming a nice base that we can generate a nice and stable yield at a cost-effective way. So I just wanted to end this off with this last slide. This is a kind of a summary of the various asset classes. So as you can see, this is quite a complicated thing. So the private market is very, very varied, and it depends on when you measure things and how you, in the fund in terms of the vintages, it really drives a lot of the differences and the numbers here. But there are some averages here that you can see. And as part of a balanced asset allocation, what we're trying to do at CapBridge would be to future-proof your portfolio. And as we move towards that, definitely one should consider how to construct the portfolio to better spread the risk and reward profile. So here's some of the food for thought then. So with that, I'm really pleased on our partnership with ARA Minterest, and now here hand over to Sharon. Sharon is the Chief Commercial Officer, and she'll be sharing further on the specific asset class of real estate. So over to you, Sharon. Thanks.
Thank you, Johnson, and good morning to everyone. Once again, thank you to CapBridge for co-hosting this session for all of us, and thank you to the participants for making time to attend today. So again, for us, I think we'd also like to just quickly reintroduce Minterest, just in case some of you still don't know who we are. We are basically a digital investment platform, and we aim to serve both individuals, the mass affluent, all the way up to corporates, as well as institutional level investors. Our aim is really to democratize assets to alternative investments across the range of the market, but we have a specific focus on private credit or private debt from companies, and also institutional grade real estate for both debt and equity. So these are some of the stats of the fundraisings that we've done on our platform to date. ARA took a stake in Minterest last year, and they are now a very strategic, significant shareholder. Most of you may be aware, if you're based in Singapore, that ARA is one of the largest real estate asset managers globally, and certainly within Asia Pacific, they've actually become the largest real estate asset manager, overtaking CapitaLand. So their shareholding comprises of John Lim, the founder, Straits, Robert Pincus, and most recently, Sumitomo Mitsui has come in for a strategic stake as well. So as we both said earlier, both Minterest and CapBridge share a common vision. We want to provide bite-sized access to investment opportunities, and this enables investors to diversify their own portfolio. So moving on quickly, we want to cover a few types of alternative investments. Today's focus is on real estate. So I'm going to jump right in on why you need alternative investments and what is it. So most conventionally, investment asset classes people think of would be listed equities, fixed income such as bonds, and various types of alternatives to cash, right? That could range from your fixed deposit or money market solutions. The alternative investment universe is covered by Johnson includes private equity, private debt, unicorns, and real estate as well. So the returns on your portfolio really depends on how you've allocated to each of these investment classes. Obviously, in particular, we believe alternative investments should form a key part of your portfolio because of the diversification benefits it provides. So we see very strong appetite for alternative investments growing in the region. Singapore is taking the lead in terms of accessing the alternative investment space. And this is expected to almost double, by 2024. And if you look at the right side chart, it really shows that, again, the Asia Pacific growth in the use of alternative investment, the growth rate actually far outstrips Europe and even the US. So, and not surprisingly, the millennials also take to alternative investments a lot better than the boomer generation. But the Gen X is not far behind, right? So I think the mass affluent is really also where you see the largest uptick in growth. It's slightly more than doubling in between now and the next 3 years. So specifically, real estate within the alternative investment universe, we believe really helps to improve the risk return profile of a portfolio. And that's really because of how real estate is less affected by things like interest rates, but is also more affected by economic trends such as urbanizations or demographics of the country and the location. Asian investors are driving the bulk of this growth. You can see from, I guess technically the low of 2009, which was post GFC, till 2018 in this chart, the Asia Pacific real estate allocation has grown significantly. And this is driving a lot of the cross-border activity into Asia Pacific. And even for Europe, some of that growth is driven by alternative asset classes such as student housing and nursing homes. And I think you may have read some of this in the news as well. So the main reason that real estate is attractive is because it does have a lower correlation with equity and bonds, and therefore it makes for a very good diversification, and it's a very important piece to your entire portfolio that we think you should consider. This just shows how the different asset classes are performed over time. So this, again, a recap of the alternative investment universe, and today we for us, we are focused on the real estate piece, and we will take you through the different types of real estate investment opportunities, and later on specifically on real estate equity that is being provided in the market today. So I'll hand it now over to Alvin. Alvin, please.
Thanks, Sharon. I'm Alvin here, so let's move on to the next part of the presentation. Okay, let's start from the introduction to real estate. So over at Minterest, we offer a suite of private debt investment opportunities for various risk appetite, with the most secured being at 3.5% to the higher risk ones at about 18% per annum. So there are also varying tenors to suit the different time horizons for each investor, with the shortest deal at 30 days to the longer dated ones at 36 months. In fact, most of our deals are around 12 months or less. So we are the only platform that offer consumer loans as part of our investment offerings through our consumer financing arm, Minterest Money, so which has a money lending license under Ministry of Law. So on top of the working capital and invoice financing opportunities, we also offer institutional grade investments that are not readily available to your typical investors. So imagine with the minimum investment amount of $2,000, you can actually invest in a commercial building in Korea, or invest into a note that has an underlying of 24 properties across 6 Asian countries. So next, I will proceed to explain the different type of real estate investments. Singaporeans really like invest into real estate. So everyone old enough will recall that the long queues in show flats and the flipping of the OTPs for instant profits. But nowadays, you can see record-breaking prices for purchase of private properties and even HDBs. So, however, there are many other alternatives to buying physical properties. and they can be largely categorized into two types: your direct investments and your indirect investments. So for indirect investments, these are your typically like your physical assets, like your residential, your office, or retail space, or industrial space. And the indirect investments can be further classified into a public market and a private market. So public market are like your equities, your stocks, your REITs, your mutual funds, even like your real estate ETFs, or debt instruments like your bonds, CDOs, and CMBs. These are easily available through the public channels like your banks or even stock exchanges. The private market, on the other hand, is not readily available to the typical investors. Example like your private funds, crowdfunding, your real estate holding companies, which has offered mezzanine debts or syndicated loans. But many times, this minimum investment amount, the quantum, are much larger than your private offerings. So next, I'll provide further insights to these real estate investments in the next few slides. Now, first, let us understand the capital stack of a typical real estate investment. So capital stack is the total capital investment into an asset. Generally, they are categorized into three parts: the equity, the mezzanine, and the senior debt. Each represents a different risk and reward profile. The equity offers the highest returns, but it also represents the highest risk for the investor. There are no cap to the potential returns. It is dependent on the exit or the sale of the asset. In the event of a default, they are the last in priority to get paid after the parts of that capital stack has been paid. Next, the mezzanine debt is subordinated to senior debt. They are ranked second in order priority. Returns are generally lower than the equity holders, but higher than the senior debt holders. This is often referred as the second chargee of the asset. Senior debt, the lowest risk of all, but also has the lowest returns as well. They're first to get paid. They're often referred as the first chargee of the asset, or has a mortgage lender, and comprises about 75% of total project costs. So next, I'll move on to the different type of real estate investments. Physical properties. So these are properties or assets that can be purchased as a purpose of investment, or either through capital appreciation, rental income. It can be residential, commercial, or industrial unit. Each comes with their own risks and rewards as well. So the advantage is that there are uncapped returns depending on your entry and exit price. The rental income if the unit is tenanted as well. But the disadvantage is that it's the high capital outlay and it's also very market cycle dependent. There are varying degree of cost and maintenance for owning a physical property as well. Next, REITs and mutual funds. So these are actually companies that own commercial assets, and you are able to invest into these companies via the stock exchange. Mutual funds are professionally managed by fund managers and have a mandate to invest into various securities. So these investments offer low entry point, diversification across different asset class, without the risk of actually purchasing the physical asset. Usually there will be regular dividends and there is no lock-in period. However, these are long-term investments that are sensitive to interest rates and prone to the market volatility as well. Next, we'll have the real estate private equity funds. So these are actually professional managed funds that invest into real estate. And these investments involve acquisition, financing, or ownership of the asset, either through directly or indirectly through an investment fund. They also offer diversification into the various asset classes, but they're not easily accessible by the public market and offer high returns as well. That's for the risk. They also have high risk as well. So they are usually accessible by the institutional investors or ultra high net worth individuals. This investment would have a minimum lock-in period of 3 to 5 years and have complicated structures. So the minimum investment amount is typically between 1 to 5 million. Next, I'll move on to the real estate crowdfunding. So there are two categories into real estate crowdfunding. First, we'll touch on the debt portion. And this involves pooling investors' funds to fund the debt portion of the real estate project, or has an investment as a mortgage lender. Most of these platforms are only open to accredited investors. So the advantage are that they have low quantum for each investor, short tenors that accept back and offer a fixed return of typically around 5 to 8%. But they also low liquidity as the investor have to hold the investment to maturity. Next, we have the crowdfunding for equity. It's similar to the previous example, except that it is to fund the equity portion of the capital stack. the project or investment. And they also often open to accredited investors only. So they are low quantum for each investor and there's no cap to the returns. But they're also high risk compared to the debt and they have a longer holding period compared to REITs. So there's also low liquidity and the investor would have to hold to maturity. Okay, next, I'll preview 3 of our upcoming real estate offerings that that fits into our example earlier on, which has the equity portion. So what you're seeing now is actually our very first real estate equity fund. It is for stake into a newly renovated office building with a retail podium, and it is actually in the heart of Singapore's vibrant civic district. This asset has attracted strong tenants like your Alibaba, Lazada. Actually, if you guys could just Google and you have an idea where the building is. There's also a strong tenant mix. Other than Alibaba, Spotify and Zalora and a few of the committed tenants. And this asset is also well connected with 2 nearby MRTs and a few minutes drive from CBD and town area. The offering for this investment is the investment tenor for this project is about 12 to 18 months with a return target of 10 to 12%. The minimum investment amount is 200,000 and the tentative launch date is expected to be July 2020, next month. Next, I'll move on to the mezzanine portion. This is actually a co-investment alongside ARA with the mezzanine loan with the underlying being a luxury residential development located about 6 minutes walk from Surfers Paradise in Gold Coast, Australia. This project is actually de-risked. The units of development has been 100% pre-sold. And we have also mitigated the risk of the FX as well. So this offering is in Sing dollars. The offering is for a tenor of 12 months with a net return profile of 6 to 6.5% with a bullet repayment, meaning that the principal and the interest will be paid upon maturity. Lastly, we would have the first charge of an asset. So the investment is actually our first charge on Conserve Shop House along New Bridge Road. The first tranche will be launched for a loan of $1 million for the purpose of refinancing from the existing lender with the possibility of a second tranche, which is projected to be 2 to 3 months after the first loan has been disbursed. The second tranche will be for a loan of 6.8 million. And this is actually for the extension of the lease of the extension of the lease of the land to 99 years by SLA. So there's actually a low risk, given that the LTV is less than 50%. The projected valuation of shop house after the lease extension is to be at 17.9 with a total loan quantum of 7.8 billion. At the same time, there are multiple exit options, given that we have a first charge, and then if the exit will be a refi from the bank or the sale of the property. From my understanding, there are already a few in-principle approvals from the banks as well. So the first tranche will be launched in the coming week with a quantum of 1 million for a tenor of 12 months with a net return profile of 5 to 5.5%. The interest will be paid quarterly and the principal upon maturity. So next, I will showcase one of our past deal. This deal is actually our very first deal that is placed on the platform. It is together, co-invest together with Straits Real Estate and was launched in May 2020. This co-investment is actually into a the 3 million mezzanine loan note in respect to a 64-story high-rise residential development located in the west of Melbourne. This offer actually has a 3 months tenor with a rollover option and a net return profile of 5 to 5.5%. And this interest for this tranche for this investment has been very strong, and we have launched 12 tranches so far. And the first tranche was closed within 11 minutes. So with that, I'll hand back to CapBridge for the Q&A session. Thank you very much.
Thank you, Alvin. Okay, thank you to all our speakers for your time and for sharing, about institutional grade real estate equity. I believe, it's always great to hear from you guys because, this is really something that's coming up, and it really shows that there's a lot of opportunities in the market for investors out there if they're looking to, diversify and future-proof their portfolio. With that being said, we've come to the end of the presentation by our speakers. We'll move into Q&A right now. So for any, all of our attendees, if you have any questions, feel free to pop them into the question and answer box in the Zoom chat function below. While we wait for attendees to come up with some questions, why not I get the ball rolling first? I'll just have some questions from interest. For the benefit of some of our attendees who may not have the opportunity to attend last week, maybe let me just ask a question that has been asked previously before. There was a question previously about whether the deals are capital guaranteed. So maybe either Sharon or Alvin would like to share a little bit more about how the structure is at Minterest.
Okay, I'll take that. Okay, the deals on our platform are not capital guaranteed. So investors are actually advised or encouraged to have a look at the fact sheet that is launched on the deal itself. However, having said that it's not capital guaranteed, a lot of deals are actually secured with assets. For example, like the real estate deals, a lot of times they are backed by, let's say, a first mortgage charge, or they have a security package that kinds of assignment of the income, the rental income of the asset. And for our corporate deals, a lot of times the deals are structured in the sense with collaterals. There's a minimum of personal guarantee from the directors or the sponsors. At the same time, we also look into we structure the deals differently, where we do offer the insurance package as well. For example, like some of these that we launch, there is a trade credit insurance backing the receivables that we have. So what it means that in the event that there's non-payment, the insurance company will actually step in and make the repayment as well. So I would not say that our deals are capital guaranteed. There's also risk involved, and investors are encouraged to do their own due diligence and to understand the structure and the deal and what is the cost in terms of the deal. So I hope that will answer the question.
Thanks, Alvin. I think that's a lot clearer as well for the benefit of our viewers. There is another question from an anonymous attendee. The question is to Johnson. What's the timeline for the launch of CapBridge tokenized wholesale bonds, and will it be made available to retail investors? Johnson, you'd like to take that? Yeah.
Yep, thanks for the question. I think there was a previous question about what is our timeline for also the PE and VC funds. So in our four product categories, we have already launched two. So the third one being the VC and PE, we are targeting for Q3. So we're in the final stages of testing this. Sorry, this is for the wholesale retail bonds. So in Q3, our plan is to launch the fractionalized LISCO bonds. We are focusing firstly on the accredited investors for Singapore. So in Singapore, because of regulatory rules, we will start with the accredited investors first. Having said that, as you may have read, CapBridge does have some certain exemption to approach the retail investors from MAS. We are working with the regulators now to try to make this through a structure that is suitable for retail investor. But for the retail investor in Singapore, probably this is going to be towards the end of the year, because obviously we need to satisfy the regulators. We feel that we have a strong case because if we can protect the principle, because this is designed to be a new product, we feel that this may be suitable. So we are making a point on this. But yeah, for initial launch, it'll be restricted to the accredited investors under our current licensing. And then moving on to Q4, as per one of the questions, we'll be launching our PE and VC funds. So again, it's the same playbook and concept here, whereby we're providing access to previously only the ultras or the family office have access here. and doing this through kind of an SPV feeder fund structure, or another structure that can make it more cost effective to break this down. So those are the product pipeline, and yeah, it's always been our view that we want to do this in a stepwise way, in a very responsible and regulated way. And I think we've also made this very clear in some of the earlier newspaper and media articles that we see that we do want to open up some of these selected products to the mass affluent, because the classic question has always been, is someone's financial literacy based on wealth or based on your knowledge? Because you can have very not so wealthy people with good financial understanding, and you can also have very wealthy people with very poor financial understanding. So it's always been a case, and we've seen in the US, the whole argument between the retail investor and the accredited investor. And I think there's been certain regs there in the terms of Regs D and Regs A, that they are opening up some of these selected products to the retail investors. And I also see that this definitely a global trend, and that's exactly what we're trying to work on at CapBridge. Yeah, thank you.
Thanks, Johnson. Okay, so maybe let me throw up a question to Minterest. So I believe, there's a question from an anonymous attendee as well. For Minterest property deals, the minimum investment is 200,000. Would Minterest in the future consider reducing the minimum amount to 2,000 instead? I believe, Sharon, you would like to take this.
Thanks, Daryl, and thanks for the question. So for certain deals, so for example, the one in Australia, the mezzanine deal, that one we do have to maintain a minimum 200,000 because it was part of the structure and conditions we agreed with the sponsor. But for the other deals that were highlighted by Alvin, so for both the shop house as well as the equity deal, we will be launching a retail tranche. So typically what we do is, for example, the equity deal, most of the investors that make up the 10 million placement will be AIs, will be accredited investors, because we believe that they understand the product better. But we will be carving out a smaller tranche. We haven't decided the exact size yet, but it would be anywhere in the range of 500,000 to $1 million, where the retail subscription will be allowed. And in that situation, we will be lowering the investment amount possibly to as low as 2,000 or even 5,000. So do look out for that.
Also, maybe I could add on to what Sharon has mentioned. I think having the deals that I mentioned, the shop house and for the equity deals, we would have a retail tranche. At the same time, we would have the AI tranche. But however, for AI tranche, if the investor has declared that they are an AI, I think we are able to lower the investment amount from 200,000 to, let's say, 50 or 100,000. So there is we are looking into it as well. So just keep a lookout, and if you are interested, just let CapBridge know that you're more than willing to connect with the investor to discuss further.
Thank you, Sharon and Alvin. Okay, since I have no other questions right now, so maybe just let me ask one from my end as well. How does Minterest, assess a corporate deal, right? Because I understand, you guys have quite an interesting way of structuring and assessing your deals in terms of the risk and reward ratio. So maybe one of you like to share a bit more about that?
Sure. So we actually developed an in-house algorithm and credit scoring system. So we call it a mint grade. So this mint grade does not correspond to your traditional Standard & Poor's, Fitch, Moody type of grading, but we do start our grading at AA, A, B, C, and D. So obviously, as you go down from AA to D, it's a lower credit quality as you go down the alphabet, right? So the credit scoring system is based on a multitude of information and factors that gets put into the model. It obviously covers both quantitative and qualitative parameters, including the financials, the cash flow projections, our assessment of the promoters, their track record, their net worth, and also an assessment of the security that's provided if there's any. So all of that is a proprietary model.
So maybe I could add on to Sharon. For corporate deals, yes, we do have a team. And for real estate deals, actually we work quite closely together with folks in RA, given their expertise in the real estate space. So these deals are all pass through quite a robust due diligence process for our real estate, and at the same time for our corporate deals as well.
Okay, thanks to the both of you for that answer. I'm also waiting for more questions to come in. In the meantime, I don't have any questions. So for the participants, I'll definitely feel free to type. We do have around 5 more minutes of time. Maybe just let me ask a few more questions on my end as well. For the benefit of the people who missed our previous webinar as well. This whole webinar topic is about future-proofing your portfolio. We have been talking about alternative investments, private debt, institutional real estate. So why should investors consider such alternative investments as a part of the portfolio, right? It's been increasing in popularity, but why now?
Yeah, maybe I can take that, Daryl. Thanks for that. So I think there's a big shift now in terms of the debate between the public and private markets. So the traditional asset allocation model has been the 64-40, and primarily in the public space. So people usually buy 60% bonds, 40% kind of equity, and this has been going on since the 60s, right? I think the notion now is that today, with the emergence of technology, the public markets and private markets are blurring now. And that's exactly what firms like us and Minterest is trying to do, right? To provide the access and the wider choice to the individual investors in order to now access those products which were previously only available to the private wealth clients or family offices, or for that matter, the institution. So I think I showed a slide about some of the return profile, and I think especially into today's low interest rate environment, there's a growing sense that the public market valuation is very toppish now. In fact, we have seen a lot of trend that the fund managers and all are increasingly going to look towards more in the private space. And there were articles now that there are about $6 trillion worth of dry powder that is, sorry, not 6 trillion that's been allocated, and about 2.4 trillion in dry powder that's yet to be deployed. And you can see the rise of specs and all, right? So the general view is that there's a lot of opportunity because of the valuation gap. And previously, people tend to stay private for a longer time, but the latest data has shown that more companies, more private companies now are taking the public route because of this higher premiums now paid, especially for high growth companies. So with that in mind, as part of a portfolio, it makes sense to actually consider now to actually put some money towards this private markets, the alternatives. And there's been quite a few case studies done. I mean, one of the more famous one is the Yale. So Yale University, their endowment fund, they have shown that because of the asset allocation towards the private space, they have been able to show a superior rate of return. And there's quite a few case studies. So we as in the private market space feel that we should definitely make this opportunity more accessible and more available, and that's part of our fit strategy. Yeah, thank you.
Thanks, Johnson. There are a couple more questions from the audience as well. Maybe let me just, in the interest of time, combine them. I know, don't worry for questions if you know we can't get back to you immediately. I'll definitely put you in touch with the respective personnel from either CapBridge or Minterest side. Just feel free to put your questions to us and we will get them answered if you can't answer them right now. So one question to Minterest. You know, for the 3 launches shared in this webinar, what are their credit ratings? If you could share them now, that'd be great. If not, of course, we will definitely get back to the person who asked.
I think we will have to get back to the person who's asked, because typically we will only publish this on the actual launch of the deals. And secondly, a lot of the Mint credit ratings that we've done in the past was associated with corporates, right? Because you know, when we think about assessing a corporate deal, which is based on working capital needs or an invoice financing, it's very much tied to the operational cash flows of the company. Whereas in real estate deals, typically, depending on the nature of the deal itself, whether it's under development still or it's a completed asset, the assessment is typically more on the cash flows or the exit of the investment and the asset. So the corresponding A for a real estate deal may not be exactly the same as an A grade for a corporate deal. So that's what, you know, I think I would like people to understand up front. But for the specific deals, we will have to get back to you because they haven't been officially launched yet. But most of the time, most of these real estate deals will be in the A region.
Thanks, Sharon. I think that makes it a lot clearer as well. So for the person who asked, you know, that ties in quite nicely with the other question, which I'm going to put up to Johnson. You know, there's a lot of regulatory regulations involved around, you know, what information we can release or not at the moment. So do reach out to one of us and we will get back to you individually so that we can answer your questions much better. So moving on to the next question, in the interest of time, maybe just let me cap this as the final question. What is the regulatory standpoint in opening this alternative investments to non-institutional and AI investors? I believe Johnson would like to answer this.
Yeah, so thanks for the question, and it's a nice wrap up to, you know, how to future-proof your portfolio. So I think the regulation is moving, and I think as what we earlier also talked about, there's a big debate now about, you know, what is the financial sophistication test? Is it based on knowledge or is it based on wealth? And I think there are more and more growing camp now that it should be based on knowledge. So under the regulation, there is always there are quite a few complicated regs, as always the case. So there's a small offer exemption that some people some of the products can rely on. There's also the retail suitability test and all, which some funds with the right prospectus can actually go under. So there are many ways to structure the products, but the main thing is that to be very transparent, private market investments have been deemed to be a very, very high risk, right? Because you can lose your whole principal. So I think obviously from the regulators' perspective, their job is to make sure that people understand this, that you may lose your whole investment sum. And I think where we are trying to kind of find the middle ground and the middle bridge, so to speak, is that you know, we could have various structure and risk mitigation. So the argument is that you know, yes, you know, we should make this available to sophisticated retail investor who understands the risk, and you know, as a control measure and a risk mitigation framework to ensure or best provide that there are avenues to protect this, meaning that if you can sell it down or you have a means to liquidate the position so that you don't lose it all, or you know, providing other safeguards to actually protect some of the underlying assets. So I alluded to earlier that there are corporate bonds and all which are pretty high rated. I mean, some of these are available to the retail side. Most of them are not. So the argument would be that yes, there are corporate defaults. I think for some of the selected products, especially the higher rated one, they should be could be, I should use the word, could be made suitable to the retail investors. So yeah, it's an ongoing thing, and that's what we are trying to build this as a win-win proposition for everyone. Yeah, thank you.
Okay. Thanks, Johnson. We've run out of time for the webinar. So once again, thank you all attendees for attending and spending your time this morning with us. There isn't any other questions for us as well. But if you do have any questions, feel free to pop them to us, our CapBridge representative, and we will get them answered. To our panelists, Johnson, Sharon, and Alvin, thank you for sharing your thoughts with us today. It's always great to hear your thoughts, and especially hearing from you guys. There's so much opportunities, and in terms of pipeline, not just for CapBridge that what we're offering, but also Minterest your side, in terms of the deals and launches coming up as well. So definitely looking forward. So with that, let me end the webinar right now. Thank you for your time, everybody. Have a great day, and we hope you definitely learned something from all our sharing today. Thank you, everybody. Have a good day ahead.
Thank you, everyone.
Thank you. Thanks so much.